Test, test. I don't know. I mean, uh, uh, thing. Yeah. Very powerful. Well, really.
Out for anticipated lawsuits, since it's closer. By just statements.
Tonight, we're gonna talk about that as a matter of fact. Yeah, yeah. Yeah, it's a great question. It's a part of tonight's lecture, and there are two criteria that determine that. If the expense is probable, we'll talk about probable, and estimable, yeah, estimable.
You can actually estimate it.
Yep, if those two conditions are met, then you need to accrue for it. But rarely, that's a discretionary call. And rarely does the company claim to be able to meet those two.
Probably internally they're calculating.
Probably internally they're calculating it. If you put it on the books, then it's a good chance that a prosecuting attorney will recognize that, see it, and say, Judge, look at this. Even they think this is probable. They think they're guilty. This is a sign of guilt. So companies will take great pains to sidestep that one.
They think this is how much this will settle for.
Yeah. Yeah. Yeah, they'll play that one very close to the vest. Curious, what prompted that question? That come up in real life somewhere?
Yeah, I would.
Okay. And that's why you don't see it on the books. You don't want to tell people stuff like that.
The size of lawsuits. I mean, my company in the financial services company. So sometimes they have big lawsuits, so, you know, I was thinking about it again.
Yeah, now
About my firm.
the lawsuit would have to be disclosed as a material event. It's just a question of whether or not the potential expense gets put onto the income statement. You know, and then readers of the financials can judge for themselves how serious it is.
Well, you did say something about that at one point. So it was in my brain, because I'm learning.
Yeah. Yeah, I hear you. Okay, it's 5:30. I don't wanna waste your time. I'm not able to get you out of here a little early. If you have enough time to go grab a cold beer or something, a heck of a lot better than sitting in this class listening about accrued liabilities that we're gonna talk about. As usual, I want to point out a couple of the areas of this section of the balance sheet where we're going to be talking about tonight, and how these expenses and liabilities actually make it onto the balance sheet. And in several instances, you won't be surprised to hear me say that we have to estimate the future and how it's going to unfold so that we can make a good faith guess at what our expenses are going to be. And anytime you hear me say that word estimate, you're supposed to think to yourself, anybody? There might be some shenanigans at play here. If I wanted to get myself paid, this is exactly where I would go into some area of accounting that requires me to estimate someone and or something. Anytime you're trying to pretend that you know how the future is gonna unfold, who's gonna tell you that you're wrong? Your crystal ball can be as clear or cloudy as anybody else's. So we got a little fudge factor in how we prepare the numbers. My partner and I were having this conversation today, as a matter of fact. He comes into my office and he's preparing an internal set of financials for another outfit that wants to have a conversation. Call it a strategic partnership or whatever. I don't know if any good can come from it, but we're to the point where we're exchanging. And he says, well, what should I do with this number? It's only 8,000, but should I accrue for it or should we use cash? I said, well, you could make a case to do either. He said, well, it's $8,000 higher if I use accrual. I said, now you're thinking like an accountant. So when you know the rules, you're gonna set the table to make yourself look as good as you can possibly make yourself look. And I think that's just kind of business, and I think that's just kind of human nature, and it's important that we understand the rules of the game so that we can see through it. Somebody's motivation and how they might just so the table. But before I just launch into another lecture on accrual accounting and the liabilities section of the balance sheet, let's pause for a little course check-in. This is the first time that we've met since the window for the first exam closed. Complaints? How'd that go? Okay. Usually the first exam goes pretty well. There's a lot of review material on that first exam, so it gives us an opportunity to kind of ease into the semester a little bit. The second exam is a lot more technical. Last week's lecture is a lot more technical. Tonight we're talking about some technical stuff. The homework gets a little bit more technical. The homework's a good gauge of what you might be able to expect on the second exam. Then there's some practice exams out there, so great. Let's do a little check-in on the research report. That's a third of your grade. We need to be kind of making subsequent milestones as we go through the semester. That's just a guideline. If you're behind, consider yourself to be in good company. Everybody's behind. This stage in the semester is how it works. We'll cram those last 3 weeks, but start pulling your materials together. Start looking at these sections of the balance sheet for the companies we can do business on. I'm gonna try to move quickly through this section tonight because I want to reserve a little bit of time at the end of the class to go through the fact set. I was playing around with the fact set last week, and I found a section that I want to point out to everybody in class because I was surprised at how much of this assignment fact set will do for you. They'll generate a pretty decent analysis report on any company that you the program. So I want to show you how to access that. And then I want you all to turn that into a source document. I want you to draw, but I don't want you to plagiarize it, but I want you to draw. But remember, this is a finance class. It's not an English class or a humanities class. I don't expect you all to be great authors. I expect you to be great analysts. So just cite where your sources came from and why or why not you agree with them. And this research project will turn into something that's pretty manageable. Okay, any questions on anything? Okay. Well, then tonight we're going to be talking about liability recognition and non-owner financing. What is non-owner financing? Debt. So we're just going to be talking about the debt. So when you line the balance sheet up, you have assets equals liabilities plus owner's equity. We're talking about liabilities, we're talking about debt. They come in 2 forms. They come in short-term debt, they come in long-term debt, and then they come in quote unquote working capital. So those would be those accounts payable line items that you see on the balance sheet. And we're going to look at a couple of what we call accruals. Now, when you hear that word accrual, what's the difference between accrual accounting and cash accounting? I pause here because that can be a stumbling block for a lot of students, and the nomenclature is much simpler than it sounds like accrual accounting just means that we owe somebody something. And now when I go to the, I don't know, when I go to my computer and I dial up Amazon and I order 2 reams of paper for our copy machine, that's a transaction. So it hits my credit card and that's an account payable and the paper comes to our office and that's paper goods on our balance sheet. When we get to the end of the period, so a quarter or a year or whatever we're closing our books for, there are always a certain number of liabilities, stuff that we owe that we have not yet accounted for. So this is stuff that we owe that hasn't come from a transaction during the period of time. And I'm going to give you an example of this. When we get to the end of the year, 12/31/2025, how can we owe something that we haven't had a transaction from?
We have a lease, we have insurance.
We have a lease,
Savings.
we have insurance. Either one of those could be an example. I'm gonna start with a simpler example and then we'll move to something a little bit more complicated like one of those. The simplest example that we see is wages. So you all have a job or have had a job or know somebody that has had a job. And when we get to the end of the pay period, very seldom does that fall on the second or the fourth Friday of the month where you might get a hand of payment. So your employer likely owes you money on 12/31/2025, but they haven't paid you yet for the couple of days in that pay period that you worked. So the employers legally by GAAP, generally accepted accounting practices, they have to record that payable as a liability. So you get to the end of the pay period and they're just gonna make an accounting entry for a transaction that hasn't happened yet. And that's called accrued accounting, and it's for accruing for liabilities. There's no fuzzy math and accruing for wages payable. We know exactly what we owe people. So we just gotta put that as the wages payable on the balance sheet. Now, there's a whole bunch of other things that we might have to accrue for that will require estimates, and we'll talk more about that. Our authors give us a good snapshot of how you're gonna see this on the balance sheet. You all should be familiar with that at this point in time. They give us a good definition of the basic concept of accruals, which we just talked about, expenses that we need to put on the balance sheet at the end of the period. These are routine contractual liabilities, and our authors give us 4 bullet points here for the most common. Wages, unpaid interest. So if we have a loan, if we borrow it from the bank, we're gonna pay interest on that loan probably at the start of each month. So the accrual for that may not be terribly large, but if we haven't paid that interest in a while, we might have to put that on the books. Income taxes owed, it's another very common, and then other expenses like rent, utilities, incurred, which touches on both for one that you just mentioned a moment ago. We're gonna talk a little bit about contingent liabilities. This is where the fuzzy math does come in. Any gamesmanship, shenanigans, funny business that you're likely to see is gonna be down here underneath these 2 bullet points. So litigation. There's, we're just talking about this. There's 2 criteria that will determine whether or not a contingent liability shows up on the balance sheet. Those 2 criteria are, is it probable? So with litigation matters, you get sued for anything. Whether you deserve to be sued or not, somebody can put your name in a lawsuit. And it's actually very common for somebody to put an innocent, I'll say innocent, an innocent third party's name in a lawsuit. So I've had this happen to me in my career. I wasn't the innocent party, I was one of the, I was one of the parties that was pissed off and duking it out. But the other business in this countersuit that we had going, we had some partners that were just fighting over an opportunity. Well, the other party had sued us. And then also named as a co-defendant one of the employees that worked for us, which was I don't know how to describe it. It's just one of those things that very often happens where you'll throw a suit at somebody else and you'll name as many people as you can name as defending parties. So that you make the other person's life as miserable as you can possibly make. And that's consistent with everything I have learned in my career about how lawsuits work. Try to avoid them. And take that all off. They are time drain, they're a money drain, and by the time you get out of them, you're generally thinking to yourself, I wish we would have just taken that first settlement offer, we could have washed our hands of this and moved on, but I think you have to learn that lesson for yourself. We're gonna talk about warranty liabilities tonight. Warranty liabilities are gonna look very, very similar to module 5 structure, where we talked about reserving for bad debts. And we talked about what else did we approve for in module 5? Bad debt expense and sales returns and allowances. So when we make a sale, we know, I think we were looking at Levi jeans. We know 3% of the jeans that we sell are gonna come back. So we have to make an estimate for that and adjust sales from gross sales, less sales returns and allowances, which their estimate equals net sales. So tonight, we're gonna look at warranty liabilities and estimate the expense that needs to be on our books because we've sold, I think the example is this, it's Harley Davidson. When we sell Harley Davidson, we know a certain number of those are gonna go bad, we're gonna have to replace XYZ part, and that's gonna cost us XYZ dollars. And we need to put that on our balance sheet. So here's the simple transaction in its raw form for any of those that we just looked at about starting with wages payable again when we get to the end of the period. In this example that our authors are giving us, we owe $75 in wages. So it's a very simple accounting entry. We're going to debit wage expense and we're going to credit wages paid. Just that simple, and now it's on our books, and we'll close those just like we do our books at the end of every accounting period in our balance sheet. We have a brand new accrued liability, yay for us. We talked about unearned revenue in module 5, and I tried to save everybody a little pain because it took me an embarrassingly long amount of time in my career to recognize that unearned revenue and deferred revenue were the exact same thing. So I've started a little petition of my own with the Federal Accounting Standards Board to purge one of those terms. I don't care which one. I just don't think we need two terms that mean the same thing. So, but you all are going to have to deal with the fact that there's two terms that mean the same thing, and that's just confusing. But you'll treat them the same way. Unearned revenue is a liability. Deferred revenue is a liability. We've entered into a transaction that requires us to deliver a good or service in the future. So we don't owe cash. We owe a good or a service that we have to deliver in the future. That good or service has a cost associated with it. That cost shows up on the balance sheet as a liability. Let me check my notes here, make sure I'm still on schedule. Okay. I mentioned these two terms when we're looking at accrued liabilities. The standards that we use are, is it probable? If it's probable, then we move on to the next standard. Is it reasonably determined? And maybe it's on the next page here. I'm looking for this word here, estimable. So the standards are, is it probable? Yes or no? If the answer is no, then you're done. If the answer is yes, then you move on to the next standard, which is it estimable? If it's a lawsuit, you're probably having a conversation internally with your management team and coming to the conclusion that it's not probable and it's not estimable. That's the stance that most companies take, because if it's a lawsuit, then you actually put it on your balance sheet because you determine that it is probable or it isn't estimable. then an aggressive prosecuting attorney is likely to say, hey, judge, look at this. Even they admit that this is probable by their own standard, and this is estimable by their own standard. That's a de facto admission of guilt. And you don't want to admit guilt, so most of the time, the way corporate claims works is that just never shows up on the actual claim. Even if it does meet those, you're not gonna put it on the statement or figure that they'll be held against them. You do have to disclose it, and you all need to go looking around in the fine print of your 10K, so look at the footnotes for any potential lawsuits that might be disclosed. Recognize that they're never going to cop to it as actual probable or estimable, but it's now it becomes your job as a financial analyst to say, okay, I know that's a lawsuit that's never going to show up on the balance sheet, but that doesn't mean that it's not going to affect the company in the future, and it certainly doesn't mean that it's not going to affect me as a shareholder when it actually does hit, just the judge finds them guilty and they have to pay a fine of who knows what. So be on the lookout for that and be prepared for the negative consequences that might come from something that was withheld or deemed to be not probable. Okay, now let's move into warranties expense, because this comes with the caveat that we're going to have to estimate. So, this example, let's just walk through it so we all understand what's going on here. Sales during the period were $10,000. We want to assume that 2% of those sales are defective, and those repairs cost $5. So our warranty expense is $10,000 times 2% times $5 equals $1,000. So at the time of sale, we're going to record this future expense and current liability. So we do that by simply recording or making a debit of warranty expense, and then we're going to credit warranty payable. That flows through to retained earnings. In the second transaction, we delivered 1,000 in replacement products to settle warranty claims, in which case we're going to debit warranty payable and credit our inventory. And that ends up being a pretty simple transaction with the estimate being right there, the 2%. So you all know where I'm going next. If you wanted to increase your net earnings per share, profit margin, every other return on equity, every other little ratio that we identified in night one as driving your management team's incentive-based comp. How do you adjust, manipulate this estimate to get yourself paid? Lower percent. So here we've assumed that 2% of our product goes bad. Well, that costs us money. That's directly proportional to the warranty expense we're going to put on our income statement. Well, if we want higher earnings, we want lower expenses. So if we want a lower warranty expense, then all we have to do is assume that we're making better products this year. Boy, I think we have the best team, the best group. They're hustling harder, making better motorcycles, whatever it is. You start telling your story. I'm thrilled with the quality of products that we're putting out. That warranty expense is going to be as low as we've seen it in the last few years. For list your reasons, come up with a good story, and then instead of 2%, make it 1.5%. And now you've just dropped 50 basis points worth of margin right to the bottom line. Now, the auditors are kind of looking over your shoulder, but you'll find that corporate America has a very friendly relationship with most of their auditors. Keep in mind who pays the auditor's bill. Well, at the end of the day, it's the CFO that's writing the check to the auditor. So the auditor is incentivized to give the CFO as much latitude as they possibly can. When the CFO comes to the auditor and says, we really invested a lot in our quality of goods and services, that warranty expense is going to be low. The auditor's going to say, okay, well, complicated. So you'll be able to kind of see how this is all unfolding, when you look at this table in the back of the 10K, this is Harley's warranty notes. And we want to analyze it just like we did sales returns and analysis, sales returns and allowances. We want to analyze this just like we did bad debts expense. We want to look at it over time. You know, how much have they been accrued historically? And what is that assumption that they've made? What is that estimate that they've made? And is it legit? And then just like we do with every other section of accounting, if we come to the determination that, they might be playing games with the numbers, we're gonna throw it all out, come up with our own estimates, and recast the financial statements. The terminology, you've heard me use that terminology in this class several times this semester, recast. That means we're coming up with our own version of the financial statements. They're not for anybody else's use other than our own. And then we can share that with our portfolio management committee, we make decisions on that, but we're acting on our own when we recast those financials. You'll never see those in the light of the public. Those will never be issued to the bank. Those are for our own use only. So you can look at those numbers. You always have beginning balance warranties issued during the period. We want to calculate warranties issued as a percentage of beginning balance. Very much like we've already done in the past for those other sections. So our authors, I don't know if I'm getting old or if our authors are getting old, but let's see. Well, here. Here it is. Okay. This point made me smile. Analysts can undo potential earnings management by adjusting warranty numbers. This is, we're in the 7th edition of this book, and I've been cynical for all 7 editions. But this is the most cynical I've ever seen the authors. So now the authors of our textbook are putting it in print that they call it earnings management. I call it shenanigan, gamesmanships, following the penny, trying to get yourself paid. They're calling it earnings management. So it's become so prevalent in corporate America that the authors of our text now are starting to talk about something called earnings management. That's like, it used to be, it's all labeling. When I was going through school, I used to, for whatever reason, I wasn't big into marketing. I thought marketing was, I was an accountant. So you know how accountants are with marketing majors, it's not the same language. The longer I've been in business and run my own company and work with clients and have to negotiate partnerships, see that what really drives success, the more respect I have for marketing. Because this is just marketing. Earnings management. When you change the label, you change the impression. And when you change the impression, you drive sales. So Wall Street did the same thing in the early 90s, late 80s, when they changed the terminology for what was then called a junk bond. Anybody know what the new terminology for junk bond is? Maybe you've never heard the term junk bond. Distressed. Okay, that's a whole different category that's adjacent. Close. That's a part of it. The terminology was it's one more guess. Not investment grade. Oh, that's very close. Yes. I'll give credit to that one. Also called high yield. So you have investment grade, non-investment grade or high yield. Non-investment grade and high yield, both were just commonly referred to as junk. Oh, those are junk bonds. And then as soon as they changed the name to non-investment grade and high yield, what that simple name change did was that it opened the door to a world of investing that was never a source of demand for that category of debt. So now all of a sudden, institutional investors that were legally required to act as fiduciaries on behalf of other people who they were investing their money for. So think 401k investment. You have fiduciaries, you have plan investment fiduciaries that are required to act in your best interest, assuming that you're the 401k participants here. Well, how do you defend that to a judge? If you're in front of a judge, one of the participants files suit against you, they say, hey, you're not doing your job, you're legally required to act in my best interest, and you got junk bonds in the lineup here? What's up with that? Well, you can't defend junk bonds. But if you relabel it to non-investment grade or high yield, well, you can do your job with high yield, you can do your job with non-investment grade. Open the door to $1 trillion market and the whole space just exploded. And now companies that historically found it very difficult to get financing, now they have access to finance. And, you know, you can argue whether or not that's a good thing for the economy. It might create a little bit of moral hazard at certain points, but at other points, it generally does give financing to new ideas that add to GDP and grow our economy. So I'm a big believer in good marketing now. Let's recast the financial. Analysts determined the historical average of warranty expense was, there's our calculation. We just take warranty expense for the last 3 years and divide by revenues. Historically, it's been running just under 1%, so call it 0.9. We want to recast the financials as if it had ran at 0.9 for the last 3 years. So we have the adjusted warranty expense. We calculated that in 2020, 2021, 2022. The difference to be adjusted. So we have the adjusted expense minus the actual expense. So we have to increase our warranty expense by 1.1, I guess that's billion, 8 billion, 7 billion. And then after that adjustment is factored in, we have adjusted net income down here. So net income jumps by close to $1 million, net income falls by 7 million, net income jumps by 5 million. And there we go. It doesn't give us the earnings per share numbers, but let's just assume for the sake of this conversation that those are material adjustments. And they probably do increase earnings by a penny or so. And if that's all you need, then Cushenberry's class was worth your time. All right, let's talk about short-term debt. GAAP requires us to differentiate between short-term debt and long-term debt. And this is primarily for the purposes of liquidity analysis. And I want you all to understand how your businesses are going to fund their short-term debt. I want you to understand how they're going to fund their long-term debt too. But first, we have to look at the immediate debt that's coming due instead of the next 12 months. See a plan for that. If you don't have a plan for that, then you're probably in the high yield category. If you do have a plan for that, then you might be in the investment grade debt category. And we're going to look at some of those ratings that help us determine that. So our short-term debt. Pretty standard. Look at that. Will be differentiated from our long-term debt. This is the table that you need to find in the back of your 10K. This will be in the notes section. This is Verizon that we're looking at here. Verizon has a principal balance coming due over the next 5 years. Looks like $224 billion worth each year for the next 5 years. Now, we touched on this earlier in the semester, but I want you to ask yourself how they're going to fund this. That answer might be obvious. If Verizon's earning $500 billion a year, well, then they probably have the cash coming in this. Right now, that's how most people fund their mortgage. You have $1,000 mortgage payment due every month, and you earn $2,000 in wages every month. You got a pretty good plan for paying it off. Same story for Verizon. You got a $225 billion debt coming due. If you're making $500 billion, you got a pretty good plan for paying that off. Unfortunately, that's not how a lot of companies work. A lot of companies don't have the cash flow coming in and pay it off, which is a little pink flag. I want you all to recognize that as a little pink flag. Not a red flag, but it's pink. Because it's very, very common for a company to go to the bank and say, I have $225 billion worth of debt coming due. I don't want to pay it, or I can't pay it, or I have other investment opportunities that I want to deploy that cash for. Can you help me out? And in good times, the bank is always going to say, yeah, you've been a great customer of the banks for 20 years. Here's $250 billion, go pay your debt. We call that strategy evergreen debt. And it works as long as you have a functioning economy and a healthy relationship with your bank. Almost always you can go back and just delay those payments for the next year. The problem is that once in every 20-year period, you get COVID, or you get a great financial crisis, or you get a tech bubble, or you get an S&L crisis, or you get an oil embargo like we had in the 1970s. Okay, I just took about 50 years. Then we had 5 events. All of those resulted in a liquidity crunch for the banking industry, whereby your bankers were stressed. And in that environment, a lot of companies got told no. So if you're using an evergreen debt strategy, you're making a pretty aggressive bet that the economy at large is not going to see any exogenous shocks that would put stress on the banks. Because when that happens, you're going to go broke. And that's one of the core tenets of Warren Buffett's investment strategy that has allowed Berkshire Hathaway to become so successful over time. Why is Berkshire Hathaway sitting on nearly $500 billion in cash? Because they have deployed this strategy very, very successfully over time. You look at those 5 periods of stress that I just outlined, and almost every one of them, Berkshire Hathaway was a buyer. I remember we went to the Berkshire Hathaway annual shareholders meeting in 2009 after the great financial crisis of 2008. And Buffett opens the whole conference with a pocket watch. So he pulls out his pocket watch, and he's got it off loud, so he's bringing that over to the microphone. It's like, take on. And Buffett says, puts it on the slide, every one of those checks is $8 million. Because he had negotiated during the depths of the great financial crisis a sweetheart deal. He actually kind of had it over a barrel, because Buffett was the lender for last resort to Goldman Sachs. Goldman Sachs was about to run out of money, and they came to Berkshire Hathaway and they said, we need a loan. All right, I'll give you a loan, but it's going to be very expensive on very favorable terms to Berkshire Hathaway, and there's going to be conversion privileges associated with that loan. So it's debt today, but if your stock takes off, I have the right to convert that debt into Goldman Sachs stock at some point. And all of those things came together to make that one of the most profitable periods of investing for Berkshire Hathaway, which is another way of saying that the moral to the story is here, you're taking on a lot of risk if your strategy is evergreen debt. But if you want to be the other guy on the opposite end of that transaction, bide your time, sit on a bunch of cash until the world goes crazy, and then put it to work. Okay, long-term debt pricing. I want to talk a little bit about this because this gives even very tenured, educated, astute investors, chief financial officers, smart people, this gives them fits. And you all have been exposed to this before, but I wanna take it step by step, make sure we all have a thorough understanding of why. When interest rates go up, bond prices go down. Okay, that's what you need to have memorized by the time you graduate. When interest rates go up, bond prices go down. We're gonna walk through the mechanics, because I want everybody in this class to understand the terminology and why it functions like that. But it does give a lot of people fits, because I guess when you don't have an MBA, and this is not your world, the thinking is, oh, great. Yields on bonds just went up. I can make more money, bonds. What people don't realize is, well, I had 40% of my portfolio in bonds, and all the bonds I just held, their value went down. But the yield went up. So I'm net probably in the same place, but let's look at how. Okay, couple of key points here. Bonds function like stocks. When a company wants, we were talking about Verizon just a minute ago. So when Verizon wants to borrow $250 billion in cash, you can't just go to a bank and get $250 billion. You have to go to the bond market. So you're going to go to a brokerage company like Goldman Sachs, and you're going to work with them to create this debt instrument. And the debt instrument is a bond. They're typically denominated in $1,000. And it's gonna have a coupon associated with it. And that coupon is the stated interest rate. So let's just use round numbers. If I have $1,000 and the stated interest rate is 5%, then I have a $50 coupon payment that's gonna 5% on 1,000 is about $50. Then I have a $50 coupon payment that's gonna come annually, but it's usually paid semi-annually. So you get $25 in June, $25 in December. And that's the basic math of the way a bond works. So you have this terminology there. Okay. Talk about coupon rate. Let's talk about the market rate. The coupon rate in that example I just threw out there was 5%. When interest rates go up, so today Verizon issues bonds that pay 5%. Tomorrow, interest rates across the world go up to 6% or 7% or 8%. The price of Verizon's bonds that trade in a market just like stocks, so we're all trading these bonds around, they're going to decline. Because why would anybody in this room pay $1,000 for a bond that's only yielding 5% when we know interest rates go up, so we can come right over here and buy an AT&T bond for $1,000 that's gonna pay us 6%. You would. So how do market forces naturally make that transaction or bring that transaction into equilibrium? Well, the way that works is nobody that holds $1,000 Verizon bond is gonna be able to sell it to anybody else for $1,000. You're only gonna be able to sell that for $950. Or whatever the math is to make that an equivalent transaction. Because you can come over here and buy $1,000 bond from AT&T, they'll pay you 6%. So if the Verizon bond's only paying 5%, then the market price of that is going to be something less than 1,000. It's going to be $950 or $970 or whatever it is that makes those two things equal. I'm going to show you how that math works, but the terminology is the market rate or the effective rate that makes those two things equal. So present value formulas here will help us derive what's really going on. Let's assume the following. We have a face amount of $10 million, a 6% annual coupon rate, so 3% paid semi-annual. This matures in 10 years, so we have 20 semi-annual periods. So the semi-annual interest payments, 10 years times 2 equals 20. That's $10 million times 3% or 20 payments of $300,000. So 20 payments of $300,000 equals $6 million. At the end of the 10-year period, at the end of the maturity period, we're going to get our $10 million back. So we have two cash flows. We have a series of $300,000 payments and one lump sum payment at the end of the term for $16 million worth of payments. Now, if the market demands 3% semi-annually, meaning that interest rates are at 3%, the bond price is 10 million, and we call that bond being issued at par. Okay, that's a pretty simple scenario. Let's take a look at what happens when interest rates are higher than 3%. If interest rates are at 4%, look at the math. Well, now we know that our interest payment is $300,000. We just determined that we had 20 of those payments. So if we look at the present value factor of $300,000 paid in 20 payments at 4%, and we can discount that back with a present value factor or financial calculator or an Excel spreadsheet, use whatever you want. But that's just simple time value of money. If we discount those payments back at 4%, we can see they're worth $4,077,099. Let's do the same math for the $10 million payment that we receive at the end of the term. If we discount that back at 4% now, because that's the prevailing interest rate, add those two up, and the present value of that bond is now 8.6 million. So if interest rates rise, if we issue a bond with a coupon of 3%, and that's issued at par value on day one, and then interest rates go up to 4%, well, we can use that time value of money math to solve for what those bonds are worth today, 8.6 million. Those are the basic mechanics of the way interest rates work. They work in reverse when interest rates go down. So in this example, if investors demand 2%, then now all of a sudden this bond's worth a lot more because it's paying 3%. Of course, we'd rather have a bond paying 3% than we would have a bond paying 2%. So we have the same payments, $300,000 times 20. Use a present value factor. That sums up at 4.9. The principal that we receive at then the term is 6.7. Now all of a sudden that bond's worth 11.6 million. Okay, those are pretty simple examples, but I'm hopeful it's a good refresher for everybody in the room. Okay, and on slide 29 here is your cheat sheet. If you ever need a little refresher, this exhibit 7.1 is a good, just star that. You come back to it, remember where we were. If you're on the exam, it's open book, open note, remember. So you just kind of want to teach yourself how to navigate through all these slides and all this material so you can reference it quickly on the exam. You might see a lot of this terminology listed in a prospectus. These offering memoranda or prospectus that accompany the issue of these large notes are really pretty interesting to read, or they can be pretty interesting to read because they'll disclose things that are not in the 10-K filings. If there's any covenants associated with these notes or other restricted terms, this is where you find it, and the appropriate disclosures are sometimes receipt disclosures associated with these documents that are not in the 10-K. So that's beyond the scope of this class. I just want to make you all aware that for any debt issuance, you will have these documents filed with the SEC. They can be pretty lengthy. A couple hundred pages is not uncommon at all. If you go over into the Bloomberg terminal room, you can pull up all of the offerings for Verizon or any other company that you're looking at, and the Bloomberg terminal is going to kind of dish this up into a screen that looks something like this. So you can see VZ is the ticker here. You have the date. You have the bond description, issuer description, Verizon Communications, industry, security, how it's denominated, so euros or dollars, the rank. So this is senior unsecured. So that means that if you look at the balance sheet, this has a senior position in the capital structure to anything else that's labeled in future, and you'll be able to find a cap table in the 10-K filing that lists all the issuances and their seniority. This is also unsecured, which would have been disclosed in this filing here. So there's unsecured means there's no collateral associated with this. And then you see the ratings over here. So we touched on ratings just a minute ago. The line of demarcation for non-investment grade to investment grade is triple B. So this is rated triple B plus. So you have triple B plus, triple B minus, double B. If you sink the double B, you've just slid from investment grade to non-investment grade. So there are 3 ratings above non-investment grade right now. Okay. Let's move on. Okay, let me go over here to slide 37. I want to talk to you a little bit about bond redemption, bond extinguishment, and just like a company, we haven't really touched on this any model, but we'll talk a lot more about it with treasury stock. Treasury stock is a transaction where a company like Verizon can buy their own stock back in the publicly traded markets. Why would you do that? Well, most commonly you view that as an opportunity for a company to positively signal that their stock is cheap. Management should be in a position to know whether or not their stock is cheap or expensive, more so than anybody else involved. So if they're buying their own stock back, of course that's a good sign. That's the conventional way of thinking about this. The same transaction can occur in bond. So you can buy your own debt back. If Verizon issues that debt at 3%, and then interest rates go to 5, 6, 7%. Well, that debt is going to fall significantly. The price of that debt is going to fall significantly in the publicly traded market. So Verizon might look at that and say, we just issued $10 million of debt on that last slide, and interest rates rose to 4%. We do the time value of money math, and all of a sudden that $10 million bond was only worth $8.2 million. Well, Verizon might say, I can buy that $8.2 million back, and that difference between the 10, which I collected in cash, I have the $10 million in cash. I can buy 8.2 back. I just pocketed $1.6 million with a symbol of my hand. That's a gain on extinguishment of debt. And when and if that happens, if we see that, you're going to see a line item show up on the income statement that says gain on extinguishment of debt. That's the basic transaction. It's disclosed here. I forget what company that we're looking at here, but this is from a public disclosure. It says early debt redemption costs during 2002 were reported pre-tax early debt redemption costs of $1.2 billion, primarily in connection with tender offers during 2021 were reported pre-tax. So this went the other way around. This was Verizon buying back their debt that had appreciated. So this is an instance where they issued it at 3, fell to 2, the debt went from 10 million to 11 billion. They bought it back anyway and took a $1.2 billion loss. Why would they do that? There would absolutely be tax effects, and when we get into that area of accounting, I'm much about here, so maybe. I don't know why they would have done it. One position that they might have taken would be, well, we already lost $1 million and we think interest rates are going to continue to go up. So we're going to take our losses now before we get more losses. Another position might be, well, they were entering into some merger, some acquisition, some other technology, some other transaction that required them to buy their own debt back. That's a very common deal point where you have to buy all your debt back. There's a lot of reasons that might have been. But they did take a loss on that, and it's not uncommon to see. But you want to have a little bit of curiosity when you read about something like that. The first question that I want you all to condition your minds to ask is, well, why are they doing it? What's the driving force behind that? What's the transaction? How's that gonna affect their business next year and year beyond and year beyond? The fair value of that debt will be disclosed in the notes. Find that table, understand how a company's debt is trading. Later in the semester, when we do our discounted cash flow analysis, we're gonna have to compute a weighted average cost of capital. This table is very important for a discounted cash flow analysis, and I think this is an underappreciated notion in finance. I don't think we teach this as strongly as we should be teaching. To accurately calculate the weighted average cost of capital, we need to base that on the marginal cost of capital. Being, how much is it gonna require you to borrow if you have to go to the bar, if you have to go to the bank today, if you have to go to the markets today, given the fact that you're already 60% levered. If you don't have any debt on your balance sheet, then you can probably borrow for 5 or 6%. If you're 60, 70, 80% levered, you're probably gonna be paying jump rates of 9, 10, 11. This table is gonna disclose all of the issues and what their current interest rates are at based on market. And that in turn is going to allow you as the analyst to a little aha moment saying, okay, well, they're already paying 11% on this debt. There's no way they're going to be able to finance anything in the future to fund expansion plans or mergers and acquisitions or any other activity that they want to fund. So the growth opportunity for this firm is going to have to come from organic current projects or not at all. So that allows you to be a little skeptical when you see something like that and discount the growth rates, or at least ask some probing questions so that you understand the strategy at hand that management's trying to deploy to drive future growth. Okay, I am not going to talk to you about time value of money concepts. If you need a refresher on that, Learning Objective 7.5 will give you the refresher on that. And there's a video that comes with the course book that will walk you through it. But it's all review, so we're not going to talk about that tonight. What I do want to talk about is FactSet. Okay, let's see here. Okay, so I came over here and I logged in. I gave all of your names and email addresses to Dr. Clark, and he told me he was going to set you all up with FactSet login access. I see a couple of heads shaking. If you haven't gotten an email to confirm that, email me. Don't email me. Just email Dr. Clark. It'll just take me out of the loop. I'll just slow the process down. Email Dr. Clark, and he'll get you access to this. It's a very powerful program. You come out here, log in, and let's see here. Somebody give me the name of the company that they're working on. T. Rowe Price. TROW, TROE, TRWE.
We'll get there. TRO.
TRO.
W.
There.
No E.
No E. Okay. Okay, so we're looking at T. Rowe Price, and we have all of these different menus that are available to us, and I don't even know them all yet. But what I found, so I'm under the news menu. Let's see. Oh, that's okay. Okay. Great. Okay, so now, now we're looking at Boeing. I had that pulled up last time. TRO. W. Jeez. Okay. Okay, there we go. So it's going to give you a snapshot, company profile chart that you can play around with, all of the key stats, symbol, volume, CEO, just great stuff. All this belongs in your report. Here's equity structure. So you're going to be able to understand who owns T. Rowe Price, who their major shareholders are. You're going to be able to track their buying activity. You're going to be able to track their selling activity.
You have tabs down here for M&A activity, the different funds that own T. Rowe Price. Just everything that, not everything, but almost everything you'd want to know about the company for your report is over here on the left-hand side of the menu. What I wanted to point out to all of you tonight was that if you go up here under a My Apps tab, you can come down here to something called a book builder. And you can create, well, you can create a custom book, or they have FactSet curated templates that include public information book, post earnings call book, or company quick book. I think the template I was playing around with was the public information book. Let's see what happens when we click that. So we have send email notification, create book. And it's just gonna do a sweep of the FactSet site, put it all in a downloadable PDF for you. Go download that PDF, turn it into a source document for your research project, and you will have done yourself a good service. Let's see. I don't know how long it's going to take to, well, I guess I already ran one for Boeing. Let's look at that one. I don't have to wait for T. Rowe Price. So here's Boeing's. It's a 28-page report. Let's see if I can download that. Download. There it is. Okay, and we're looking at the one I ran for Boeing. So we have company snapshot, capital structure, management, M&A summary, financials, estimates. Great stuff. Great stuff. So check that out. Look at that report. Familiarize yourself with it. Anytime I stumble onto a new tool like this that can make your life a little easier, I want to make sure that we share it. And this is a really good one. Any other questions on FactSet while I have it open? Yes, he's the gatekeeper for our FactSet subscription. You don't have the option of book builder. Let's see. If you go into My Apps, I found that, I think I found that under My Apps, and then like there's an Explore tab maybe in here somewhere. My Apps. Do you have a reporting menu maybe? Maybe it's manage tabs. No. Browse app catalog maybe? Yeah, this is where it is. Browse app catalog, then go to reporting and click on book builder. So My Apps, found it? Okay, good. Thank you for asking. My Apps, browse app catalog, reporting, top menu, and then book builder. And play around with those menus. If anybody else in class finds something that is particularly interesting or is helping you out, let me know and I'll share it with the class. So that's all I had prepared for tonight, gang. I can get you out of here 15 minutes early if there are no objections. One last chance for questions. Anybody? All right. Class adjourned. I will see you in 2 weeks. We'll be having online class next week.